All right. Okay, real estate investors, it is time for Mike's market update. And this is February, so we'll go over some macro stuff that's going on currently in the market. And then locally, we'll get into some micro stuff based on numbers from January. So real estate market is all on fire right now. Let's get started and dig into this. We'll start with some macro updates here. And right now, the key term going on is inflation, inflation, inflation. Everywhere I go, I see something about inflation. I hear questions about inflation, but the talk is really focused on inflation. And so there's some things I wanted to point out. So here's a headline from Bloomberg. Janet Yellen, the new Treasury Secretary, defends stimulus package while acknowledging the risks. So you're going to see across the board right now, both at the central bank level and at the presidential White House level, there is no concern about inflation. They're all about doing too much to get through the pandemic rather than doing too little. So the thought process there is in 2008, coming out of the Great Recession, we did not do enough stimulus. There's not enough quantitative easing. We could have done more that would have shortened the recession out of that period and then made the crisis containment much faster on the back end. And here's another headline from the Fed. So Daly, that person with the last name Daly that works at the central bank, they are a voter on monetary policy this year. So they are playing down inflation, but other people are warning of risk. So in the stock market, we're getting some hedge fund people that are warning about risk. We did have inflation numbers come out on Wednesday. So the consumer price index was flat. So what I've been talking about is inflation as measured by the central bank, and really is only matters from the central bank level because the central bank is the one that makes monetary policy decisions, right? So the way they measure inflation determines what they do with interest rates and what they do with quantitative easing. So the way the Fed measures it from consumer prices, we're not seeing any inflation. And so that means they can keep interest rates low. And what we do know, though, that the way that the Fed reacts to how inflation is measured shows up differently in asset classes. So we've seen that in Bitcoin rallies, gold rallies, silver rallies, stock market rallies, real estate rallies and whatnot, because the way that the Fed works is the Fed adds money into investors' pockets, right? The Fed cannot spend money. The Treasury can spend money. They're the ones that can give direct stimulus payments to Americans. And then that would increase consumer spending, which can create upward pressure on inflation. But that's a limited amount of quantitative easing or limited amount of fiscal support that won't show up much in the actual consumer price index. However, the way the central bank works, which is putting more money in investors' pockets, does add inflation to assets. And so that's what we're seeing here. There is concern, though, that, so here's an article from Citi Strategist saying that a correction is probably due by the end of the year. That is saying that we are seeing inflation in the stock market, right? So the stock market's currently pricing in the $1.9 trillion stimulus plan that Biden has on the table. And so if we don't get that additional level of government spending on top of what the central bank is doing, then there is concern that maybe the stock market pares back. And remember, the stock market's very volatile, right? It can move overnight, it can move sharply, it can in both directions. Real estate does not function that way. Real estate's a much slower market, so I'm not concerned about a correction in the real estate market, but it is quite possible that we'll see a correction in the stock market if we don't see a stimulus package pass at the level that Biden currently wants, because it is priced in. My favorite index, we'll get into mortgage credit availability. So you can see it went up in January. So we've had 3 months in a row of it coming back up. So after that big, huge decline in March, and then again in April, we've saw 1 month up, 1 month down, 2 months down, and then 3 straight months up. So mortgage credit availability is coming back. And a large percentage of that, we'll look at historically, again, we're back in the 2013, 2014 level, which is fine. That's good. We're not way too much mortgage credit availability creating an asset bubble in real estate, but we have enough mortgage credit availability to keep the market flowing. So that's what I like to look at in mortgage credit availability standpoint. And one reason that mortgage credit availability is so high is, one, there's a lot of volume, there's a lot of money in the mortgage-backed security market, keeping liquidity in that market, keeping mortgages flowing to the point where we could see a record year of actual mortgage amounts hitting, going over 3 trillion. So we've only gone over 3 trillion in mortgage loans twice, once in 2003 and then back last year in 2020. So it's quite possibly we go over that level again here in 2021. The other reason credit availability is up, not because the amount of money, the liquidity, right? So the central bank is buying financial instruments. They're buying mortgage-backed securities and commercial mortgage-backed securities. So that adds more money into the investors that invest in those types of securities, which then allows them to pump more money into that market. But interest rates are low. So 30-year mortgage at 2.74%. You can see here we were up from the low that we saw in December, came up quite a bit. And then back down and flattened out. So interest rates significantly low. And I do want to talk about interest rates because I don't believe we're going to continue to be at the 2.74 mark. I think by the end of the year, interest rates are still going to be really, really low, but they'll be up closer to 3%. And so here's why I think we'll see interest rates closer to 3% by the end of the year. If you look at the 10-year Treasury note yield, it's come up significantly. So the low was right around 0.5% back in August, right? So we saw it come off of a cliff in March. The stock market came back, it came back, came down. We've seen these things, and then we've seen a trend, though. You can see a trend of the 10-year Treasury note going higher. And the 30-year mortgage rates typically trend with the 10-year Treasury note. The other thing and so right now as of yesterday is at 1.3%. So historically, the yield between the spread. The spread between the yield on the 10-year Treasury note and 30-year mortgage rates is about 1.5% to 2%. So that would put us at 2.8 to 3.3%. Right now, our yield's lower than that. So if we look at the yield spread, you can see it was at the lowest here early on in 2020. This only goes to November. It was at the lowest early on in Corona. And then the spread increased significantly, right? So we think of, if you go back to August, when the 10-year note yield was only 0.5 point, interest rates were still around 3%, right? And so then we were exceeding a historical norm for that spread. And as you can see that as the markets improved, that spread's gotten closer and closer and closer and back more to a normal 1.5 to 2%. Right now, if you could do our math, 1.3 is the yield on the 10-year note, 2.74 is the 30-year mortgage. So that's what, 1.4. So right now, this is since November, that's come back down to actually off this graph, right? So our yields are low. Excuse me, the spread is low, the yield is increasing, and so we should see interest rates get back up into that 3% world. Now, there is still plenty of money that is flowing into the mortgage market. Our servicers are working well. Mortgages are getting paid off. There is a chance that we'll keep that yield below the 1.5 to 2, that spread, yield and spread. There is a good chance that we keep that spread still more of like a historically low 1.5% or less. And so that's why I don't think we'll go above 3% by the end of the year. But the market is saying, hey, that spread needs to increase and the yield has been increasing. So if you think about yield on Treasury notes, it means the outlook on the market is getting better. The outlook on the economy is getting better. And so yields are going up. Less money is flowing into those really safe US debt assets, and it's flowing into other assets, so that brings the yield. So less demand brings the yield higher. So with those two things happening, I do think we'll see interest rates going up, but again, still historically low, around 3%. And then I've got projections on affordability at the local level next. I think we are getting into the micro. Yeah, so let's look at Portland. Let's get into the micro market, and let's look at Portland real estate specifically. So ridiculous amount of low supply levels, one month of supply. That's just our trend, right? So we've seen this ridiculously low trending. We hit a record low at 1.2 in July, and then it's just trended down ridiculously low since then. So let's dig into those numbers. First, what I want to look at is average marketing time. So supply levels and marketing time, that's really an indicator of competition, right? So with supply levels really, really low, meaning a lot of buyers compared to the amount of sellers in the market, that creates competition amongst buyers and upward pressure on pricing. And then same thing on marketing time. So if you can see, we have a typically historical normal marketing curve, right? So our average marketing times usually hit the lowest in the summer, makes sense, and then starts creeping back up at the end of the year. With Corona, we saw that happening, and then a correction, and then what we did not see is it creep up in the winter, right? Because the supply levels were historically low, significant amount of competition keeping days on market low. And then what that resulted is now coming into January, the lowest average days on market that we've seen in quite some time. So competition is out there. It's extremely hot. Prices are going up. Buyers, competition, bidding wars, all those types of things. And those will continue until we see more inventory hit the market, which there is no real inventory. There is no signs of significant amounts of inventory hitting the market anytime soon. So we can expect this number to stay low. And it's quite possible that for the entire year, we see average marketing times lower than we historically do. Okay, so let's look at inventory. So the number of active residential listings on the market at the end of the month. So this is inventory. A lot of times supply gets confused for inventory. No, supply is a function of inventory and demand, but the amount of inventory is historically low amounts of inventory. So here you can see in January, less than 2,000 listings on the market at the end of the month. It's about a third less, no, 2/3 less of what we'd seen recently. In 2020 was kind of actually a decent amount of inventory on the market, and we're almost half of what that is. So not enough homes on the market. That is the key ringer going through all this stuff, and that's going to kind of be the case going forward. New listings, though, we did kind of pop up, so that was good. So if 2020, we're actually almost in line with 2020. So the number of sellers coming to the market in January. So that's a good sign. So with prices going up, demand really, really strong, the thought process is that attracts sellers into the market. So we should see an increase in inventory as more sellers come to the market. They get the vaccine rules out, they get more comfortable with the physical concerns in the marketplace. That should increase inventory. However, when we talk about supply levels, right, that's a function of inventory divided by absorption rate. So let's look into the absorption side or the demand side. Pending sales, the highest amount of pending sales we've seen into January in the past 5 years. So even though inventory is really, really low, demand is so strong that we're seeing more contracts happen than we have in the past 5 years. So that is not typical. And the funny thing that's happening is as we're having this amount of significant demand taking place, we also have a refinance boom going on as well. And so the mortgage market's flowing really, really, really well right now. Let's look at the overall stats. So this is January. So you look at our median sales price. If you look at it as compared to December, it's up significantly, 11% on the average sales price, 13% on the median sales price. So this is a year-over-year outlook. I think for 2020, all of 2020 compared to all of 2019, that's what I like to look at is a year-to-date range. We're in the 11th percentile range. Year-to-date does nothing for us when we're in January because we're just, again, comparing January to January. That's why we see the same information there. So that's about all I wanted to show there, but our median sales price is increasing significantly. So it was $455 in December. Yep, $455. It's up 1% up to $460. And so that does affect affordability to some point. So interest rates have come up a little bit since December, and prices have gone up a little bit since December. So affordability has come down a little bit. So let's look at affordability. Here's December's numbers. We're looking really strong, solid from an affordability standpoint. So the most affordable the market's been since 2015. So that again is what's helping with those bidding wars. That's again what's helping with upward trajectory on pricing. This is the equation. So this is based on December. 92.1 was the median income for the Portland area in 2020. 25% of that is a $1,900 monthly payment. Interest rates in December 2.67. Median sales price is $451. So then 20% down payment leaves in mortgage. So the payment on a $364,000 mortgage at 2.67% interest is $1,471. So that means our affordability is greater than 100, right? When this number is less than 25% of your gross monthly income, that creates a number greater than 100. So our molested, the math is 140%. I double checked the math. The math is 130%. That's just a typo that they wrote. But those were December numbers. Here's January. So with that increased median sales price and an increase of interest rates, so interest rates went up, median sales price went up, income stayed the same. So that means affordability has to go down. But again, as you can see, 128%, that's very, very high from an affordability standpoint. And what I did in my big yearly forecast is, hey, project. I always like to project out affordability because that gets me an understanding of where can the market go. If our affordability keeps going down, I'm less happy about flipping properties, right? But if we have affordability continually really high, that means we can still have increase in interest rates, we can have increase in pricing, still have a functioning market, and those flip projects can be really well. So I like to project out affordability. So this is projecting a 10% median sales price from December and 3% interest rate. So like I talked about, I do expect interest rates to go up to 3%. So that's the figure I'm going to use. Income doesn't change. We're still based on 2020 numbers. It is possible, though, that our income, when we get the 2021 numbers that come out in May-ish, it's possible that number goes down, which then would put downward pressure on affordability as well. But let's just solve it, keeping that number the same, interest rates at 3%, and then a 10% median sales price increase from the 455 in December. That gives us a monthly payment of $1,700. That's 112% affordability, right? So we can see a 10% increase in the market. We just saw 1% from December to January. So we can see another 9% increase in the market and still have affordability above 100. At that point, I'm getting a little bit more concerned about the market, especially if this number comes out and goes down, and then quickly our affordability can go down. But this makes me feel good about our market for the rest of the year. At least for the next 6 months. We'll see what happens in the back half of 2021. But a great market, great time to bring properties to the market, great time to acquire rentals if you can get them at numbers that make sense because the interest rates are so darn low. And, you know, if you need to sell an asset to buy another one, it's a great time to take that to the market. So we're actually doing that right now. We sold a property earlier this year, 1031 into another one. We've got some offers on some other rental properties right now with a plan of selling another one of our buildings so then we can 1031 again. So it is a good time to start repositioning your portfolio and taking advantage of these low interest rates. Now let's solve for 1%. So if we solve for 100% at 3% interest rates, right? So our median income's the same, interest is 3%. How high can we get this number? Okay, so if we want 100% affordability, then the variable is this number. That's what we're solving for, is this median sales price. And that's a whopping 25% up from December. Okay, so if you look at December's affordability versus this number here, that median sales price can go up 25%. So if we have no change in income, if interest rates go no higher than 3%, we can add 25% to our market before we get into the 2008 affordability territory, where if we go back, 2008 is not on here. So we didn't get down to 100%. So in 06, 07, 08, affordability was just under 100%, right? And so we can still get down to that territory. We have to see a significant increase in value before we get down to that territory. So I'm not too worried about the market from that standpoint. I think it's a great market to buy rentals in. I think it's a great market to flip in. From a development standpoint, I think it's, from a development standpoint, I do think it's also a good market to buy land and develop real estate. Here's why. If you look at permitting, so this is Patrick Berry from Berry and Associates. I think they're the best apartment appraisers in the city of Portland. Patrick put this together, and this is the new permit. So by county. So this is multifamily permitting in 2020, and then allocation by county. And what you can see is permitting actually did not slow down. Permitting was relatively flat for apartment buildings throughout the Metro Portland area. What is significantly down is the city of Portland. So here's Multnomah County, which all of Multnomah County, for the most part, is in the city of Portland. Those are the lowest numbers of permitting that we've seen since the mid-90s, okay? And so when we think of the urban growth boundary, when we think of population growth for the state of Oregon, population growth for Portland metro area, density has been projected, or population has been projected to be absorbed mostly by the city of Portland. And it's multifamily zoning that can absorb the majority of that population increase. And so when we have this huge decline in multifamily permitting at the city of Portland, it just exacerbates our housing crisis, right? So with the new work from home, there's a lot of talk and concern about, hey, people don't have to live in Portland. they can get a job from an employer in Portland, but they don't have to live in costly Portland, which is true. I do believe the vice versa is also true. I think people can get a job outside of Portland from an employer outside of Portland, but choose to live in Portland. I think that effect is almost a wash on the previous. But if demand pulls back because population growth slows, the only way to put downward pressure on pricing is to then keep permitting the same. So we're adding units at a normal pace. When demand pulls back or population pulls back, that helps out our exacerbated not enough supply of housing, right? So right now we have not enough units, we have too much demand. So if supply stays the same, demand pulls back, that helps that exacerbation relieve pressure on pricing. But what we're seeing is an actual reduction of supply and kind of an unknown of what's happening with demand. So in my opinion, we are coming out of this apartment construction boom. Even the thought process in 2018 and 2019, as we were in the middle of this construction boom, was we're still not going to have enough housing. We're still going to have a shortage of housing. And once we absorb all those thousands of units that are being built, at the end of those 3 to 5 years, that absorption rate, we're going to not have enough housing. And this right here is going to exacerbate that. And so if you put that in reality or from a game planning standpoint, right now we're looking at purchasing a lot that we can build 14 apartments on or 14 condos on, purchasing it with seller financing with the plan that we can design that and permit that anytime now in the next 3 years, and then bring it to the market anytime between 2 to 4 or 2 to 5 years from now. And the timing in that could be very, very good, meaning we can potentially time bringing supply to the market when there isn't a lot of new supply hitting the market. So right now, if you're coming within a brand new apartment building to the market, you're not feeling so great because you've got a lot of competition. You've got all this inventory hitting the market. It means a lot of competition. But if we continue to see this trend in the next year or two, and permitting is really, really low, then we could be coming into the market with not a lot of competition. So that's kind of the thought process on how permitting works. But this is a sign that we just are going to have more struggles from an adequate amount of housing, not enough housing units for the number of households that we have, which then puts upward pricing on rents, upward pricing on purchases as well. So there you go. The other headline, this also will exacerbate our construction timelines, which exacerbates the amount of new supply hitting the market. But the city of Portland had their layoffs. So we've known about this for a few months, that layoffs are coming. It's now been announced in the Business Journal about what that actually looks like. So the Builder Developer Services, the Department of Builder Development Services has laid off people. So that means permitting can likely slow down, exacerbating construction timelines, all those nasty things. And so again, that just helps with the upward pricing. Depending on what side of the coin you're on, puts upward pressure on pricing, both in the rentals and in houses for sale. So, oh yeah, and there is still demand, right? So I talked about ULI's emerging trends. So Portland, for out of the past 5 years, has been in the top 10. A couple of years has been in the top 5 as far as emerging markets, where developers, this is a survey based on the supply side of the equation, developers, lenders, brokers, those types of people and how they feel about developing in Portland. Well, we went from, I think, 5 last year to 66 out of 80 markets this year. So a significant drop on how developers or the supply side of the equation feels about Portland. But again, I don't think that's a long-term thing. I think that's a sign of regulatory changes, landlord-tenant law, also the difficulty to permit in our city, combined with civil unrest. Civil unrest, I don't think is going to be around for a long period of time. And here's an example of that. So a Midwest luxury apartment developer is now moving to the West Coast. This was an article in the Business Journal. So they're really excited. They've got offices in San Francisco. They plan to develop in Washington, Oregon, and California. And so even though there are reports out there that Portland is just not a great environment to develop in, you cannot argue with our lack of housing supply, our exacerbation from a supply standpoint, and the fact that that will put upward pressure on pricing. And so that will attract developers. Some may go away, but there's still going to be people that want to invest and develop in Portland. So that's on the radar. I wanted to point that out. So there you go. That's Mike's market update for the month of February. If you have any questions, reach out. Email address, your at Rarebird Real Estate or at Rarebird Mike on Instagram if you want to ask me some questions. And we can go for there. Always happy to answer questions and give a shout out to the community. So thanks so much, everyone. Hope you enjoyed what you got, and we will see you next month.